Good afternoon and welcome to the Induction Healthcare Group PLC half-year results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all of the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand you over to CEO James Balmain. Good afternoon, sir.
Thank you, Jake. Thank you. And thank you very much for everyone who's taken the time to come and listen to our presentation this afternoon. So I'm sat here rather with John McIntosh, our CFO, and we're going to be spending a short amount of time on our year-end results for our previous financial year, and then going into more detail on our recently published interim results. So I'll get cracking. And before we jump into both sets of numbers, which John's kind of going to present, for the benefit of anyone who might be new to the Induction story, I just want to spend a couple of minutes setting the scene on who we are and what we do. So there's a couple of sort of basic things to ground everyone who's listening. Firstly, we are a healthcare IT company. So we make software as a service platforms. We have a number of them, and we operate almost exclusively in healthcare. We don't employ doctors or care teams, and we do not deliver care. We rely on our healthcare provider partners to do that for us. The second point I'd make, which is a bit more specific to the UK, but also relevant to other world markets, is we operate in secondary care. And there's an obvious difference between primary care when you go to see your GP and secondary care when you get referred into hospital or community hospital or any of the other specialist hospital services. And that's quite an important distinction and one to think about as you listen to some of our messages today. We work with hospitals, and fundamentally our platform is transforming the communication between care teams in hospitals and patients visiting hospitals. So hopefully that helps just set the scene. Now we're going to be talking today about three key products. Two of those are quite well established and are contributing the vast majority of group revenues. And that's Induction Attend Anywhere, our video consultation platform, and Induction Zesty, our patient engagement platform. Now Attend Anywhere is a video platform that allows patients and care teams in hospitals to run video consultations. So as a patient, instead of me turning up and parking my car and going to the hospital, I can talk to my care team, my consultant, or those people surrounding my consultant on video. And that became hugely relevant during the pandemic. And we're still seeing millions of annual consultations across the NHS in the British Isles on that platform today, a year on from the tail end of the pandemic. Thinking about our second product, Induction Zesty, that's a patient engagement platform. And the simple way to think about that is when you visit hospital, when a GP refers you into hospital, our system sends you a text message, you register and then log into the portal. And from there, you can do things like manage your hospital appointment, read your hospital outpatient correspondence, and also provide your care teams with information electronically. And then finally, a newer product, which we've just launched now, having been in beta development and trials with a few of our key customers over the last year, is Induction Form Builder. And that's a really topical product, particularly given the pressure the NHS is under, because it allows care teams to remotely capture data from patients without the patients having to make an in-person visit. Now, those three platforms sit on top of Induction HealthStream, which is our integration engine, and that's a really key USP for our business. And we have done integrations and have partnered with Apple. We have value-added reseller agreements with both Cerner, who've recently been purchased by Oracle, and also System C. And those two agreements are particularly important because they give us access to customers via that channel that other people in our space don't have. And finally, this year, we've done a lot of work with NHS England to integrate our platform with the NHS app. And I'll talk about that a little bit later on today. Now, the overall strategy of the group is to bring these products together, to continue enhancing them, but to sell them to our customers as one integrated platform. Now, that doesn't mean that they can't be bought individually, but we're really beginning to show now that there's direct synergy between these three platforms, and we deliver incremental value to our customers when they all operate together, particularly when they're integrated via our HealthStream platform with the underlying EPR platform that runs in hospital. So I hope that gives everybody a bit of a quick but clear grasp of who we are and what we're doing. I'm now going to hand over to John, our CFO, and he's going to take you through first our FY22 year-end results, and that's to the year ending March this year, and then our more recent interims results, which is to the end of September this year. This is, of course, if I can make the slide advance. There we go. John, over to you.
Good afternoon, everyone. My name is John McIntosh. So for FY22 audited results, as you can see, significant growth, very significant growth in line with market expectations. FY23 starting ARR of 13.5 million. That was accounting for very successful renewal of key NHS England contracts for Attend Anywhere. You can see the percentage, and that was ahead of management expectations. So an ARR growth of 650% from prior year. That relates to an audited recognised revenue of 7.9 million, and that's post this IFRS 3 fair value adjustment of 4.2 million, a non-cash adjustment. Going back to a pro forma revenue of 12.1 million revenue pre-IFRS 3 adjustment, and that's in line with expectation for pro forma revenue. Adjusted EBITDA break even, in line with market expectations, and leaving 7.5 million in cash at the end of FY22, again in line with expectations.
And I'll go forward one slide for you, John. There you go.
So as you'll have seen already, FY23 interim results to September 30th. Very good traction, again, with core Attend Anywhere and Zesty products, as James indicated, with some headwinds. The opening ARR was 13.5 million, and that was a 1 million uplift in the first half, and that represents a number of those contracts that James indicated, Zesty wins in particular, and the Zesty growth was 70% on FY22 closing number. So revenue 55% ahead of H1, mainly due to increased Zesty contracts, again, as James indicated, full period Attend Anywhere revenue, and there's this one-off project to create an integration for Zesty with the NHS app. So revenue's a bit behind internal budgets, and this is due to partner delays on implementation for Zesty contracts, and slightly weaker than expected sales performance on Switch and Guidance. Adjusted EBITDA has increased due to FX fluctuations, which you'll be aware of, and some unforecast additional operating costs, and the reduction in expected revenue that was noted above. So that lays the key highlights in the period. System C VAR signed, the new Cerner VAR imminent, and national funding announced in NHS England to support portal projects. Big opportunity, as James has indicated.
For Zesty.
For Zesty.
Brilliant. John, thank you very much. Now, what I want to try and do is just go around this pie chart just to give everyone a bit more clarity on where we are. I'm just going to make, there we go, I can read it now, brilliant. So what you've got in the middle is a pie chart that breaks down our group ARR by product line, and these numbers are as at the 30th September, which is when we report our interims. And I'm going to start with Attend Anywhere, if you look at all the various contracts we hold, expressed again as annually recurring revenue, you end up with a total, and this is the value as at today, of 11.1 million of ARR. Now, the prior year, we had about 12.8 million. And anybody who's been following the induction journey will know that one of the big challenges we saw post the acquisition of Attend Anywhere was the renewal of some 7.6 million pounds worth of contracts with NHS England. And we did quite well there, actually ahead of our expectations and ahead of the guidance we'd given the market. But despite that, obviously, we have seen a difference, a delta, between the ARR value at the end of the period and the opening ARR value as we come into this year. So hopefully that clearly illustrates that gap in ARR. We ended at 12.8, and then we began the year post, concluding all the renewals at 11.1. And I'll stress the fact that this was expected. We didn't quite know exactly how the numbers would line up, but we absolutely expected this to happen. We knew we were going to have downward pressure post the height of the COVID pandemic. And again, that was something that we factored into the pricing of Attend Anywhere when we acquired that business. Now I'm going to move on to Attend Anywhere market share. And I think it's really worth just explaining how we view this. So if you think about all of the NHS trusts in England, and it's really England we're talking about here, that's where we're most active, given that we hold national contracts in the Republic of Ireland, Scotland and Wales. So England is the area where we expect to see significant growth for all of our products, particularly Induction Zesty. But if we think about that market share across NHS England, we want to focus on acute hospitals. And the simple way to describe that is it's a hospital that has an accident and emergency. And the reason we're so focused on acute hospitals right now is that's where the waiting lists sit. So I'm sure you've seen in the press that there are now over 7 million people on them waiting for elective surgery. And it's in those acute hospitals, that's where the waiting list sits. So across NHS England, we have 128 acute NHS hospital trusts. Now, Attend Anywhere is contracted with 95 of those. And that's versus around, on our internal data, about 16 for Teams, and there's about 4 trusts that are using, a mixture of different platforms. So we're still, even post-pandemic, even post 2 renewal cycles, in a position where Attend Anywhere has very significant market share in that hospital video consultation space. And that was a key outcome of the renewals that we got through coming into the start of this financial year. If we then move over to Zesty, you'll see currently, as at 30th of September, we have around 2.4 million of contracted annually recurring revenue, and that's up by 1 million over the period of the previous 6 months. So we've gone from 1.4 million as a closing ARR number last year to 2.4 million at the half year point. And we'll talk a little bit about where we think we're going to land on the full year in a couple of slides' time. Now, taking exactly that same segment, those 128 acute trusts across England, all NHS trusts, this is still quite an evolving market. So more than half of that market don't have an integrated patient engagement platform. If you think about where we compare against our competitors, there's been quite a lot of consolidation in the last 6 to 12 months. And really the market leaders, in our opinion, are ourselves with 16 trusts and Doctor Doctor with 21 trusts. Now, what we see moving forwards and what our growth thesis is based on, particularly in partnership with our value-added reseller partners, both Cerner and System C, we've got visibility on another 40 acute trusts. So to be clear, we're going to go from 16 where we are now to 40 in total, and we expect to be able to conclude those contracts in the next 12 to 18 months. So there's quite substantial growth that we're seeing on our Zesty platform. We've already seen this year, and we expect to continue seeing. Now, one of the trends that we've experienced this year has been, particularly in the middle of the year, the last 3 to 4 months, has been a slowing down of decision-making in the NHS, and that's largely as a result of all the political turmoil that we've lived through. And hasn't caused these contracts to go away, but it has caused delays, and it's particularly caused delays in national funding. And that national funding is really important because the hospitals can draw money down from dedicated pots to pay for patient-facing services. Now we're in a reasonably strong position now in that funding has been approved, and procurements are now beginning, and we expect to see quite a lot of activity in the final quarter of the year, but it is 6 odd months late, which is what has contributed to us falling short of what we originally said in terms of revenue and contracted annually recurring revenue. If we then think about our other product induction guidance, to be honest, it's had a little bit of a disappointing year. We've only grown it by about 100,000 year on year, and we were aiming for further growth. Again, that platform is very widely used. Where we haven't delivered the growth that we wanted to deliver on guidance has been in increasing the value that each hospital pays. And if you've read our landing report, you'll see that both our clinical apps, Induction Guidance and Induction Switch, we are now looking at the role those platforms will play within the business moving forwards, and particularly the justification behind their underlying cost base. So the final point I'll make in terms of the revenue mix, particularly for ARR, is that we're seeing we still have a very strong bias towards Attend Anywhere revenues. But if you look at this picture from even 6 months ago, we're really beginning to see those Zesty revenues grow. And I think that's really important for 2 reasons. Firstly, it removes, or it's beginning to remove that all our eggs are in one basket scenario. But it also is really beginning to underpin the fact that our strategy to market and sell an integrated platform where these products work well together is beginning to bear fruit. So I'm going to move on now. I'm going to try and move on now. Sorry, apologies everyone, I'm just having mouse problems. There we go. So I want to just spend a little bit more time diving into a key metric for us, which is our ARR. And what we've done here is we've broken down our ARR for our 3 key products. We've bundled our clinical apps together because our Induction Switch product, whilst it's really widely used, has been disappointing in terms of its revenue generation over the period, over the last 12 months, but certainly over the last 6 months. So I'm going to begin with Attend Anywhere. And on the left-hand side, you can see on the left-hand side, you can see the FY22 exit ARR, so that's the ARR we start the year with. And on the right-hand side, in the orange column, apologies everybody, I'm sorry, in the orange column, you can see where we expect to end FY23. And on the red dotted line, you've got the contribution Attend Anywhere makes to our overall guidance. So I've done a bit of a poor job of explaining that. I'm going to start again. We wanted to achieve 13 million of ARR for Attend Anywhere in this financial year. What we're now saying is we're going to achieve around 11.2. And the major driver of that, we knew we were going to lose 1 million of ARR coming into the year, but the major driver of not making that ARR back this year has been slowness in our non-healthcare contract with the Department of Work and Pensions. That contract's based on usage. And it's been slower than we would like to get Attend Anywhere rolled out to the various DWP departments. And in particular, we're still working to roll the platform out to the Universal Credit Department. And that's obviously a really big department and will absolutely be a really big driver of increased ARR for us. Now, we think we're going to get there. It's just been slower than we'd like. So if you think about Attend Anywhere, we've retained the lion's share of all of the contracted revenue, which is a really good result. We haven't been able to make up that £1 million this year in the way that we thought. And that creates about a £1.8 million gap to that 13 million that we wanted to achieve. Now, if we move over to Zesty, it's a very different story. We're calling out just over 4 million of ending ARR for this year, which is only at the moment on forecast around 300,000 below targets. The target's 4.4. Now, the key thing here is our growth thesis for this year is absolutely based on being able to grow Zesty as a result of our widely contracted Attend Anywhere base. And I think the numbers show that we are actually achieving that, and we still expect to deliver a really good result on Zesty this year, which is critical to prove our strategy was working. And you can see where we began at 1.4, ending at 4.1, it's going to be really, really solid growth. And then finally, on the bottom left-hand corner, very simply, our clinical apps business, which is primarily guidance and switch, has just been flat year on year. We were looking to take it to 1.6. We haven't achieved that. And as I've said, we are now very focused on the roles that our clinical apps business will play in the business moving forwards, and also the underlying cost base associated with those platforms. Now, if I move forwards, I will, and this is really just summarising that now to show where we started, where we're going to end now, and the gap to guidance. So guidance was 19. We're going to end at around 16, just over 16 million. So yes, short of guidance, but still, a good solid growth in ARR over the year, particularly in the current climate with the headwinds we've been facing. And just to reinforce that point I made, that actually what we really wanted to see strategically was really strong growth. Our growth targets for Zesty were ambitious, and we're doing well on that front, and we expect to be pretty close to the original target we set ourselves for that platform. And I'll sum up now by just sort of reiterating where we think we are and what we think the investment case is for Induction. We still hold an established and defendable market position. You've seen some of our numbers relative to market size. Now, whilst Attend Anywhere clearly has really strong market penetration, we are leading in an emerging sector with our patient engagement platform, Zesty, and we think we're going to see really strong growth on that moving forwards. Now, we're really well positioned to capitalise on the funding that's being made available both to providers and integrated care systems. We've already won a regional deal for our patient engagement platform that also includes Attend Anywhere with South West London, and we've got a number of further ICS opportunities that are dependent on national funding in part, which is why we haven't been able to close those contracts yet, but we remain really confident that we're going to get those deals done. Some of them will get done inside this financial year, and I think some of them are going to move over into next financial year. But the overall environment is very strong. We're obviously continuing to work with DWP. We are slightly disappointed we haven't been able to make that work more quickly, but we have no reason at the moment to suspect that we won't get there. And when we do, that will trigger those increased revenues. And finally, just to reiterate the valuable partnerships we have with Cerner and System C, and to underline the fact that in our market segment, we have those relationships and none of our competitors do. Now, at the moment, we're really focused on the financial fundamentals of our business. Obviously, we are down both on ARR and down both on revenue. That will flow through to cash. To give that some colour, we have our forecast closing cash balance at the end of the year was around 10 million. We're likely to be in the sort of £6 million range. When you think about the cadence of cash flows into our business, we really have two major streams of cash. The first is from Zesty, and that has a fairly flat, even profile throughout the year. And the second, which at the moment is far more material, is with Attend Anywhere, and that cash flow is much more lumpy. We get very big contract renewal amounts coming through at certain points in the year. And a big renewal point for us is the end of March, where we expect significant cash inflows, April, May, June. And so we're very focused on making sure that we have the right size of business to maintain, a solid cash flow position and to bank those, those really significant cash inflows. And overall, our view of the environment generally is we do not want to be a loss-making business. We're very focused on getting to the point where we achieve cash-based profitability before the end of FY24. That's a key factor for us in thinking about how we move the business forwards. We talked about the market. There are a lot of structural growth drivers, and particularly for anyone who's used to working with the NHS, these pots of national money. We have the Frontline Digital Fund. We have a specialist fund that's just for patient engagement portals, and we have a larger fund which our EPR partners, particularly Cerner and System C, are drawing down to level up some of the hospitals that have older systems. So all of that money is combining to create an environment where the funding picture is quite solid. And that's a really important factor that underpins our growth moving forwards. And then the final thing I just want to address before I close is we are a buy and build company, and we absolutely do want to make further acquisitions, but I'll be candid, it's a challenging environment for that. We've seen a lot of sort of structural market-related pressure on our share price. That makes it harder to issue equity to fund acquisitions. And so again, we want to carry on buying things. We do think definitely in the next 18 months or so, we're going to start to see some really good value in the market as valuations begin to sort of come down. And I think, again, it reinforces the need for us as a business to really focus on our financial fundamentals, to really conserve our cash, to right-size our business moving forwards, to hit that cash break even, to start generating cash, which will then start to open up wider opportunities for us to use non-dilutive funding to pursue M&A. So it's definitely a slower trajectory than we would like, and I think there's a bunch of macroeconomic factors that come into play there. But we're still very focused on the mixture of that organic and inorganic growth. So I will end there, Jake.
Absolutely, James, John, thank you very much indeed for your presentation this afternoon. If I may, I will just bring back up your cameras. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. James, John, as you can see there in the Q&A tab, we have received a number of questions throughout your presentation this afternoon. And thank you to everyone for taking the time to submit their questions. John, perhaps I could hand back to you just to read out those questions, to then provide those responses, of course, where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Okay. This is the first one, James.
Yeah.
From Tom. How are your contracts structured on the basis they are ARR in nature?
Yeah, thank you, Tom, for the question. So it's normally an annual contract value. For example, the average annual value for our Zesty platform is about £150,000. If you look across all the hospital-based, the average annual contract value for our Attend Anywhere platform is about £50,000. We recognise that revenue equally by month over the year. So, for example, a £120,000 contract, we would recognise at £10,000 a month. They're recurring revenue because the contract term, is normally, in the kind of 2 to 3 year range. So the way we look at it is, if it's a £120,000 contract a year over 3 years, the ARR for that will be 120k. And the only thing to sort of think about here is the difference between the revenue we recognise and the ARR number we call out. So if you imagine that we signed that £120,000 contract in March, or at the end of February, we would only recognise £10,000 of that because that would be the final month of our financial year, but it would contribute 120,000 to our ARR number. So I hope that answers your question.
If I'd looked down, I could have followed up with the next question, which is related. How much of the ARR is maintenance based? What percentage of each deal is the maintenance element?
So I mean, our cost to operate, so we don't charge separately for maintenance on most of our contracts. We just charge a software license fee, and within that license fee is our maintenance cost. Now, it does vary by product, and it can vary slightly by customer, depending on which products they have and the iterations we're running. But the best way to think about this is somewhere between 20 and 25% of the total license fee goes on support, maintenance, etc.
Next one, different angle. Can you please talk a bit more to your current international pipeline of opportunities?
Yeah, no problem. So we look at international in two ways. We have a very small but really good team on the ground in Australia who are beginning to now organically generate business in that market, and we are absolutely expecting to have contract wins in Australia and New Zealand. It's more likely to be next financial year than this year. So that organic growth is very much kind of Australia, New Zealand story. And the customers we're talking to there are very typical. They're pretty much the same people as we talk to in the UK. Hospitals. Cerner, one of our partners, has a big presence there as an example. So in terms of organic growth, we're really at the moment focused on that Australia, New Zealand opportunity. In terms of and the other when we think about international pipeline, the other thing we think about is target companies to acquire. And we're very interested in sort of mature, sizable markets where the way health is delivered is relatively aligned to what we do, and also we have strong partner presence. So Canada would be a really good example of that. And we have a growing and reasonably interesting pipeline of international acquisitions that we're talking to and we're looking at. But look, as I said in the presentation, it's a challenging environment at the moment to raise funds to make sizable acquisitions. And I think quite rightly, we've been focused more on the organic growth opportunity that we have been on on international expansion via M&A. I think we need to, in order to be able to acquire something meaningful internationally, I think we've really got to set the bar high on the quality of that deal to justify the dilutive nature of funding it through equity. And again, I'll go back to the point I made in the presentation, which is that key to this for us to move forwards, really to meaningfully move forwards, is to get back to a place where we can start to do M&A. And if we can use things like debt and other instruments that are non-dilutive, that's going to be very good for shareholders. But we have to get the business to a cash break even in order to be able to achieve that.
Next one, more of an operational angle. So direct integration into the NHS app. How important is that when deploying new products and from a trust uptake?
Yeah, so I'll answer that one in reverse. So for a trust uptake, it's actually becoming really important. And there's two main reasons for that. If you're an NHS trust and you want to, acquire a platform like ours, to procure a platform like ours, you really want to try and get some of the national money that's been made available. If the centre's going to pay the bill, that's a good thing if you're an NHS hospital, is how they would look at it. And in order to qualify to get that funding, they have to ultimately pick a provider that is sort of approved and understood as a part of the NHS app program. Now, at the moment, this will grow, but at the moment there are only 4 platforms who are sort of on that approved list, and we're one of them. So we're in a really good position in terms of our attractiveness to NHS trusts through that lens. And then when we think about deploying, it actually isn't too much. It doesn't add to our deployment time, which I think is what you're going for there. We did quite a large, which we were paid for by NHS England, quite a large piece of work earlier on in the year to integrate our Zesty platform, particularly into the NHS app. But now that work's done, it's a relatively straightforward process to turn new hospitals on as we go live with those hospitals and connect them to the NHS app. And that is obviously both financially and operationally desirable for the people inside the NHS trusts. Okay.
I'll just wait and see if another one comes up.
James, John, if I may just jump back in there, and thank you very much indeed. I think that looks like every single question you've addressed them. So thank you very much indeed for addressing all of those questions that came in from investors this afternoon. Of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended for you to review, to then add any additional responses where it's appropriate to do so. James, perhaps before redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Thank you. Yes. So, I think I'd close by saying, like a lot of other companies in a lot of sectors, it's definitely been a challenging year. Interestingly, healthcare is a relatively sort of defensive sector. So, if you work in healthcare, particularly public sector healthcare with the NHS, you're not completely insulated from a downturn in the economy, but you are somewhat protected. What the NHS is much more susceptible, though, is political turmoil. And we've definitely had quite a lot of that this year. And I think that's the biggest headwind we've faced. And that has, that has absolutely directly contributed to us, falling slightly short of the numbers we wanted to achieve for the year. Now, having said that, I still firmly believe Induction is a really exciting business. It's absolutely front of mind for people delivering healthcare, particularly in a hospital setting around the world, that they've got to begin to really use digital channels to engage with their patients. Now, we see all the time news about big waiting lists in the UK, but there are other, mature health economies around the world that have the same set of problems, particularly where there is a public element to their health delivery. So if you think about what our platforms do, and you think about the power of our platforms when they come together, I genuinely do believe it's a case of sort of right place, right time for Induction. I think it's a really exciting business, and I think that's a good moment to wind this up on. Thank you.
James, that's great. And John as well, thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This won't take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Induction Healthcare Group PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.